Ladies and gentlemen, good day and welcome to Anupam Rasayan India Limited Q4 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need an assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Krishna Patel from EY. Thank you, and over to you, Ms. Patel.
Thank you, Manav, and good afternoon, everyone. Welcome to Anupam Rasayan India Limited's Q4 and FY24 earnings call. Please note that a copy of our disclosure is available on the investor section of our website as well as on the stock exchange. Please do note that anything said on this call which reflects our outlook towards the future or which can be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. Please note that the audio of the earnings call is the copyright material of Anupam Rasayan India and cannot be copied, rebroadcasted, attributed in press or media without specific or written consent of the company. Today, from the management side, we have with us Mr. Anand Desai, the Managing Director, Mr. Gopal Agrawal, Chief Executive Officer, Mr. Amit Khurana, Chief Financial Officer, and Mr. Vishal Thakkar, the Deputy Chief Financial Officer. With this, I would like to now hand over the call to Mr. Anand Desai, the Managing Director, for his opening comments. Thank you, and over to you, sir.
Thank you, Krishna. Good afternoon, everyone, and a warm welcome to our Q4 and FY24 earnings call. Hope you all are doing good. Let me take you through the updates for the quarter and the year gone by and how we are placed for the upcoming year. Despite short-term challenges faced by the industry, the macroeconomic landscape over the medium term looks positive. Inflation and supply chain disruptions such as the Red Sea crisis and fluctuating raw material prices due to market dynamics have caused temporary challenges. However, declining inflation, steady growth rate, and India being a preferred economic partner provides a more robust economic environment over medium to long term. On the industry front, the agrochemical and pharmaceutical industry have been facing certain headwinds pertaining to subdued demand. Our agro business faced certain challenges in the year, and we anticipate that it will continue its current trend in H1 FY25, after which we expect the demand to strengthen. Our past sustained efforts in expanding our pharma and polymer portfolio have started yielding results. Despite the challenges in the pharma industry, our pharma segment has robustly grown, increasing from 4% in FY23 to 9% in FY24. We expect the contribution of the pharma segment to be in double digits in FY25. Currently, the polymer space contributes in single digits of total revenue, which is expected to be in double digits in the upcoming fiscal year. This shift towards a more balanced portfolio with higher contributions from the pharma and polymer sectors will enhance our revenue stability and growth prospects. I feel 2025 will be a year of growth for us with our major focus on polymer and pharmaceutical space. Now let me highlight our financial performance before moving on to the business highlights. Our consolidated operating revenue for the quarter stood at rupees 401 crore with a YOY degrowth of 16%, whereas for the year our consolidated operating revenue stood at rupees 1,475 crores, posting YOY degrowth of 7%. The degrowth pertains to the challenging demand conditions in agrochemicals and a drop in raw material prices. The margins for the year and the quarter have been strong, and we were able to maintain the same. The EBITDA margin stood at 27%, which is equivalent to last year. For the quarter, the EBITDA margin stood at 25% on a consolidated basis. At Anupam Rasayan, we are committed to building a sustainable business, and over the years, we have invested in various initiatives, and now we have initiated an investment of rupees 51 crores in building a hybrid power plant, combining solar and wind power with a 9.2 megawatt capacity. This initiative is expected to save approximately rupees 15 crores per year in energy cost. Coupled with our earlier initiatives, this will ensure that 65% of the company's electricity consumption comes from green energy in the coming years. With this, I would like to hand over the call to Mr. Gopal Agrawal to discuss the business updates. Over to you, Gopal Bhai.
Thank you, Anand Bhai. Hello and good afternoon, everyone. Welcome to our Q4 and FY24 earnings call. Let me discuss business highlights in brief, post which I will let Amit Bhai take over to discuss the financial highlights with you. Anupam Rasayan has been continuously focused on expanding its product portfolio. During the quarter, we have added 6 new products to our basket, summing it up to almost 70 new products in fiscal year 24. All these products are a combination of our fluorination series and the LOIs and contracts signed during the year. The earlier launch products have already begun ramping up, and the remaining ones scale up gradually in coming quarters, impacting our numbers positively. We have also added 2 new customers, totaling 4 new customers in this fiscal year, including 2 from Japan, which has helped us strengthen our polymer pipeline. Going ahead, we expect significant growth in the polymer business, achieving double-digit growth in the next fiscal year, as stated by Anupam. Japan will become one of the major geographies of business in the next 2 years for us. With this, to take you through the financial highlights, I would like to hand over the call to our CFO. Over to you, Anupam.
Thank you, Gopal bhai. Good afternoon, everyone. Let me take you through the financial highlights for the quarter, after which I will let Vishal bhai to discuss the same further. Before getting into the financials, let me share an update related to preferential allotment. The amount collected from the fundraise was used to repay the long-term debt of rupees 249 crores during the quarter. Coming to the capex incurred as of 31st March 2024, we have utilized rupees 482 crore out of the rupees 670 crore capex announced. The balance capex would be incurred during the first half of FY25. Our working capital remains stable in absolute terms, and we expect it to stabilize further by end of FY25, with improvements anticipated in FY26. The new products launch will have relatively low working capital requirements. We are also focused on cost optimization and operational efficiency. Our strategic focus, coupled with our expansion plan, position us well for long-term growth. With this, I hand over the floor to our Deputy CFO, Vishal bhai, who will take you through the financials in detail.
Thank you, Amit bhai. Hello and good afternoon, everyone. Thank you for joining us here today. I would like to share some key performance highlights for the quarter and year ended 31st March 2024. And then we'll open the floor for question and answer session. Before I proceed, I hope you all have had the chance to go through the detailed presentation and the results submitted to the exchanges and uploaded on our website. Kindly note, our numbers for the quarter are on consolidated basis, and they include 10 fact numbers as well, and the same for the year as well. Let me first discuss the consolidated financial highlights for the quarter ended 31st March 2024. Operating revenue for Q4 FY24 was at rupees 401 crores as compared to rupees 480 crores in Q4 FY23, down 16% YOY. EBITDA, including other income, was at rupees 105 crores in Q4 FY24 as compared to rupees 142 crores in Q4 FY23, down 20% YOY. This would translate into a 25% EBITDA margin in this quarter. Profit after tax was at rupees 40 crores in Q4 FY24 as compared to rupees 73 crores in Q4 FY23. Coming to the full year performance, operating revenue for FY24 was at rupees 1,475 crores as compared to rupees 1,602 crores in FY23, down 8% YOY. EBITDA, including other income, was at rupees 411 crores as compared to rupees 440 crores in FY23, down 7% YOY, and this would translate to EBITDA margin of 27%. Profit after tax was at rupees 167 crores as compared to 217 crores in FY23, down 23% YOY. Top 10 customers contributed 77% of our revenue, and there were 25 products that we provided to them. With that, we open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have a first question from the line of Ankur Pariwal from Axis Capital. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. First question on the margins for the quarter, and I'm referring to the standalone numbers here. So we have been maintaining that our margins will remain healthy. But any specific reason why both gross margin and EBITDA margin have contracted here?
Hi, Ankur. This is Vishal. Let me take this question. Ankur, yes, our margins have been in the range of 27% if you look at it on a standalone basis. So on a standalone basis, the margins have moved a bit only because of the product allocation and nothing really anything different that we would have seen. So if you look at our margins have been consistently healthy. Yes, it has been a little lower than what we expected last year, which was 25.54% this year on a consolidated and 26.6% on a standalone. So if you look at on a standalone basis, we are corrected by 1.5 percentage points, which is normal that we would have expected when we see the kind of product mix that are there. But nothing otherwise or directionally that can see otherwise.
Sure. On volumetric basis, where will we be in terms of growth or degrowth, and by what magnitude in this financial year?
So we are talking about the past year, or we are talking about
FY24. FY24, we have around 12% decline in revenue. So how much of it is pricing? How much of it is volume?
See, if you see the revenue is volume is the large contributor to that. And as you can imagine, that has been the reason where our customers have taken in few cases a minimum volume offtake only rather than the expected volume that we would have expected them to take, and that's one volumetric reason. I would put it there.
Okay, sure. So and from a utilization perspective, we will be sub 80-85% odd levels from the aggregate capacity.
So Ankur, I would say that if you look at from a revenue point of view, we should be able to do around around 60 to 1700 crores of revenue. But if you look at from a volumetric point of view, it will be if I don't include the new capex because that's under execution, around 70-75% is the kind of a volume that we would have been using of our capacity. But as I've told in past also, this is only a volumetric. But when my these plants are very multi-purpose plants, then I can do multiple products. So if I look at my ideal product portfolio, eventually I can do anything between 60 to 1700 crores of revenue from here.
Okay. And on the working capital side, we were earlier guiding for a reduction in working capital for the full financial year. I understand the revenue degrowth and the macro behind there, but the sharp jump here in working capital, if you can put some light there across inventory as well.
Sure, you're right that the working capital have not gone to the levels that we had expected assets to go, and I would put it into three buckets for that. One, if you look at it, my debtors have expanded, and that debtors has expanded because of the sluggish growth. We had to offer our customers a longer, payment cycle, and that has led to increase in the debtor level, which we expect to get corrected over the next year, 12 to 18 months time, and bring it back to more normal numbers. One. Two, if you look at it, we had expected that we were to grow reasonably. When we started the year, we had expected a double-digit decent growth that we had expected, and at that point in time, we expected the inventories to be unwound and being utilized well enough to do that. However, because of the degrowth, you have two specific challenges that you come to. One is that my inventory velocity was lower, and hence the unwinding was slower. And two, if you look at it, was also because of the numerator-denominator situation where my numerator has shrunk, denominator has shrunk, and that has also led to a higher number of days. And the third is I have launched 17 new molecules for which there is a part of the inventory which also gets added back to it, and that is a significant number that also adds to it because when you start a new molecule, your inventories are higher, and cycle when it moves in, you smoothen that number. So I think it's a combination of these four things: debtors, slower unwinding of inventories, to lower revenue, which is making it the base, and the four is is the new molecules, which also ensures that my inventory level is a little higher on that. But going forward, our expectation is of twofold. One, we would be able to focus. We are highly focusing on this, and we should be able to try and bring this to a more reasonable number over next 12 to 24 months. This year we will see a decent correction, but and our targeted numbers we should be looking at it by the FY26, because by that time the sufficient revenue volume would have come in, and my new products would have also stabilized. And I don't need to, at that point in time, I would not need to give extended credits, which also will solve it. So if you look at all put together, I think 12 to 24 months is where you will see a very, so this year you will see improvement at the final number, probably by 24, 26 financial, we should be able to see the targeted numbers.
Okay, Vishal, two follows there. So one, you mentioned because of the receivables, we have started giving longer credit to customers. So which hopefully should sort of reverse. But on the inventory side, is there any slow-moving product which has got stuck here, and due to which the overall inventory looks bloated? I'm looking at the absolute numbers. We were at 860 crores in 22, and we are 990 crores now in FY24. So even if I look at absolute numbers, the inventory number has not gone anywhere, in sync with the revenue numbers.
Oh. No, you're right. You're right. I'm not going to say that it is not. It is the other way around. The only thing I'm saying is that is there any slow-moving or dead-moving inventory? Answer is no. Slow-moving in a sense is just that what I had expected them to move, they have not moved at the speed that I had expected. But is there any risk on those inventories? The answer is no. We do not see any risk, because these are contracted volumes for the inventory, so which I'm not worried on that. I'm worried more from the velocity of this movement, which is where I and the management of the organization is really focused on. In terms of absolute risk, I'm not too worried. And the looking that you saw the inventory was also because of the launches that we done. 17 products would also lead to a decent size of inventory that is coming up. So I think put together and that's where we are. But happy to explain further if you need.
Okay, no worries. Let me get back into the queue. Thank you.
Thank you. Thank you, Ankur.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Good evening, and thank you very much. So, two main thoughts in your business. One is on this working capital, you responded to some questions earlier, but structurally, when do you think you can bring down your overall blended number of days net working capital to maybe something comparable to a peer group company, so 90, 100 days, because you're way higher than that. And when you say that new products are going to be having lower net working capital, so what is the kind of net working capital we'll have for the newer products? And when do you see the current portfolio giving you some reduction in net working capital in terms of the structural direction? If you can respond to that, then I'll go to the next question.
Sure. So see, if you ask me for when we can see a more levelized kind of numbers, are you saying that my peers or we are talking about a target of 90 or 190 days kind of a working capital? I don't see that to be happening anytime sooner. But if you're talking about, let's say we are talking about 180, 200 days or that kind of a time frame, which is where we feel that we will have a more sustainable numbers in terms of our return ratios and otherwise, I think that is where we are targeting for that in next 18 to 24 months we should be able to reach. I'm saying it a little on the longer side is also because if you look at it, the next 6 months are looking not very, very, very favorable, and hence your room for maneuverability on this side will be limited, and hence I'm saying so. And yes, newer ones will have a little lower intensity in terms of inventory, but also we'll have to see how the data cycle plays in the Indian market, because some part of our revenue will start coming from the Indian market little higher because of the pharmaceutical, and that's where we would try to be more optimal. And hence, I would say that let's take an 18 to 24 month kind of a time period for us to achieve that.
Okay. So when you talk about the Indian business and pharma increasing the share, what is the current split between domestic and exports in fourth quarter and FY24? And where do you see this domestic export split moving, say, in the 25, 26?
So 25, 26, if I look at it, yes, historically we have been around 65 or 65, 70% as my revenue from the exports and the balance from the domestic. And I believe that mix for little sometime it will remain in that range. The only thing is pharma's contribution is going to increase. So my domestic from agro to pharma will be a move, if I were to say, because we are moving a little bit of a demand. We can see the demand of Indian agro to move to Indian pharma side. So that's where I'm trying to say that my receivables is where I'm from. Pharma next year is looking like around about 15% plus revenue contribution coming from pharma, and that's where it would be. But mix, I would put it at 60-40 to 60-40 plus or minus 5 percentage point, depending upon how quickly each segment responds over the year.
Okay, so on this segment, pharma specialty, so can you just give us the details of the split between exports and domestic for 4Q and FY24, 4Q24 and export FY24?
So FY24 is FY24 is around about 60% plus, 60 is to 40, and Q4 will be in the range of 50-52% kind of a thing. Export.
62.
50.
52.
50.
Okay, so that means your domestic business has gone up. So in the fourth quarter and
Ramesh, I would not want to read that 50 as a trend. I would read that as a pure product allocation. If you look at it annually, historically we were at around 60-65, and we will be in that range, but probably towards 60 rather than towards this. Right?
No, that is fine. So we're just trying to see how the overall portfolio is moving, how the domestic business is moving, and then because of that you are saying receivables are going up. We're just trying to understand that. So within this portfolio, if you can share some thoughts. Like your agro is more than 90%. You have given some data on how the pharma and specialties will increase, right? So what is the current share of pharma and specialties in 4Q and FY24, and how do you see that pharma and specialties moving, say, in FY25 and 26?
Sure. So if you look at my agro has been around about 65% of my revenue, 9% coming from pharma, 9% coming from other, and 17% coming from the life science. So that's where it is for the FY24. And I think what will happen is that the pharma will add to around about 15%, and other specialty, including polymer, will go to double digit. That will have a reflective on the agro and personal care, which will be in that range, right? The remaining will be in that.
So you're saying agro will be 75,
but no, agro will not be 75. Agro is 65 this year, and it should get little lower because pharma's growth will be higher than the agro's growth, and so would the polymer's growth be higher than the agro's growth, and that is where I'm saying that pharma and agro will be 15. Pharma will be 15, and agro will be other specialty polymer will be little on the double digit side. So you may see that the personal care may go down by a couple of percentage points, and agro will give up on few percentage points in my portfolio. But on an absolute side, I don't think too much will be changing in terms of agro and personal care.
Yeah. So 65% is agro, 9% is pharma and specialties now. That is about 74%. So balance, out of the balance, 25%, how much is it now? Or where does that come from?
Let me make the statement again. Agro is 65, personal care is 17, pharma is 9, and other specialty, including polymer, is 9 today.
Okay. So personal care is 17, pharma is 9, and specialty is 9. Okay. Okay, and you see the pharma and specialty is growing faster. So when you see this kind of growth, and when you see this kind of growth, and you are talking about the share of fluorination increasing. So what is the share of fluorination in FY24, and how does the share of fluorination move in the next 2 years, 25, 26?
So fluorination is around 20% in FY24, and that would grow further. I don't want to guide today in terms of absolute number, but it will grow by at least 5 to 10 percentage points. Is where I'm looking.
And this will be mostly in pharma, right?
No, it will be across polymers, across pharma, and also agrochem, because fluorination is used. See, I'll tell you what we try to look at it from a segment to segment point of view, Ramesh. But if you really look at it, what am I doing? I am doing a very simple thing. I have a value chain. I work on that value chain with my chemistries, and then it goes into the end markets like agro. Largely, it has been historically agro, but now I am now moving into if I do couple of more steps, I get into pharma. If I do couple of more steps on the side, I get to polymer. And with fluorination coming in, my repertoire has expanded, and that is where it is coming to. So it's a single differential that we are talking, but if you really look at it, it is purely a whole value chain that is playing out. And then that's where we would have to see for ourselves, because my fluorination goes in all the 3 applications.
Okay, so just to round up this discussion,
in terms to interrupt, sir, may I request you to rejoin the queue as there are several parts.
No, it's okay. Let him ask this question, and then we can discuss.
So please go ahead, sir. In terms of your operating cash flows and growth from the new products and the movement in debt, how do you see the net debt for the company, say in the next 2 years, which can possibly offset this this relatively higher working capital you're going to have? So can you shed some light in terms of your thought process on how your operating cash flows help you reduce debt and manage your overall balance sheet to a reasonable size, even with a high working capital, so that your ROC can improve?
Sure, Ramesh, it's a fair question, and I think let me answer it in a different way, because I don't want to guide to a specific number, because that may not be the right way of doing it. But let me give you directionally and the thought that the management has in terms of it. One, whatever working capital we have today, we should be able to do at least a reasonably higher number of revenue from the same working capital, and in fact on the receivable side we may be able to improve a better here. So if you look at it, the simple thing that can happen is that, do I need any more work? See, CAPEX I'm practically done, right? So I don't need any investment in CAPEX for next 2 years. So that is one thing which is solved for. Second, if you look at, I have invested significant amount in working capital, which will be utilized for my next 2 years growth. So if you look at it, next 2 years revenue or the EBITDA and should be practically getting free cash flow in that sense. And that EBITDA less the tax and interest would be a free cash flow for me, and that will be used to just reduce the balance sheet size in that sense by reducing the debt. And also please be mindful that I have the pref and warrants money which will come in next 12 to 14 months time, which will be also used to pay the debt, especially long-term debt.
Thank you. I'll join back the queue. Wish you all the best.
Thank you. Thank you. Thank you.
Thank you. We have our next question from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah, hi, Vishal bhai, thank you for the opportunity. Couple of questions from my side. First is a clarification on the CAPEX. Sir, did you mention 190 crore of incremental CAPEX you would incur during FY25?
So I'm saying that no incremental CAPEX in terms of anything new that we are going to do. I'm saying that whatever was committed, which was a 670 crores of CAPEX, part of that which is left out for the completion is going to be used to pay out, to be executed. That's all. Nothing like any additional new CAPEX we are announcing.
Yeah, I mean, I meant incremental.
Yes, it's 180. It's 180 then.
180.
Which is sitting in my cash today.
Okay. So you would be utilizing that cash towards the capital, towards the capex, correct?
Exactly. So if the question is, do I need any external financing for that? Answer is no.
Okay. Secondly, the 1,600-1,700 crore revenue guidance, that is on the standalone capacities, correct? And that's not in FY25, but in totality, it can give you the 1,600-1,700 crores revenue. Is that correct or no?
Yes, you're right. That's exactly what I was saying. That my capacity that I have today can support a revenue of 1,600 to 1,700 crores. Not that I'm guiding you for that. Absolutely right. Thank you for helping me clarify that.
Yeah, otherwise I think it would have looked more like an FY25
I would love to have that number, but I would not guide for that now.
But do you want to give any guidance for FY25 in terms of the range, particular as in on a console basis?
Okay, let me answer it in this manner. Will this be a year of growth? I believe the answer is yes. But what is that number? Give me a quarter or so to do that, because we believe that the first 2 quarters are looking. We look at a headwinds for that, and the second third and the fourth quarter is where we see a decent growth. Especially if you look at it, agrochem is one that is there is a headwinds coming in. My polymer and pharma will contribute, and that will contribute to the growth. But the net effect is something that I want to see for a quarter or two before I guide that. I hope you will be patient with me on that.
Sure, sir. No worries in that. And 2 small clarifications, if I may. So on this working capital front, so if ideally we should be looking at the standalone inventories, I think which has gone up to 990 crores or in days of sales 321 days. So just can you please give breakup of that raw material, WIP and finished good inventories for the standalone business for this financial year?
Sure.
If you have it handy.
So raw material is around about 30% of my product. My WIP and FG will be the balance. So if we can answer that offline, because I don't have it ready right now to answer that, but I can get you that offline on this.
Sure, no problem. And
or let me check if I can get you during the call. I'll get.
Sure. And lastly, if I look at the standalone receivables, which has increased by almost 170 crores. So and while our standalone sales have declined, so if that wasn't for the higher receivable, the actual top line would have declined by a much higher number. Is that understanding correct?
See, it's a chicken and how you see it, right? See, there is a bit of a my customer also have some obligations to take off that particular level of volume from me, right? Now I have a choice to incur higher pain to them or a lower pain to them, okay? Because they are also in a difficult situation as of now, right? So one way is to say that I want this volume and in this terms only as we have agreed upon, or to say, okay, fine, I'll also take a bit of a pain for you as you are also taking a pain. And that's where we have a compromise here, saying that yes, we will take the volume. They will take the volume pain, and I'll take the receivable pain. So it's a business decision. Is it a one-to-one relationship or not? I don't think so. It is about one-to-one relationship. It is purely how you work with your customers, especially high quality customers who are really working with you for so many years. You would tend to do that for them, and that's what we have done.
Understood. Thank you, Vishal Bhai, for patiently answering my questions, and wish you all the best for FY25.
Thank you.
Thank you. We have our next question from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yes, thanks for the opportunity. The first question is on the standalone. So sequentially, we have done pretty well. There could be a seasonality impact as well. But given that it's a start of calendar year for most of our exports customers, and they will be starting the year afresh, given that last year we had inventory issues, etc. What is the kind of dialogue that we are having? So whether they are they are relatively confident in terms of lifting up the volumes, given that last year those volumes were impacted because of inventory drawdown and they were taking only the minimum quantity. So what has been the dialogue, particularly from the agro perspective, given that the other segments we have already mentioned that there is a strong growth expected going ahead? Thank you.
So Rohit, let me answer this. You are right that the Q4 has a reflection of the seasonality also, and bit of a little strengthening than the last quarter. Yes, there is a bit. But are we saying that we are out of woods and agrochem cycle has now started picking up? I would put it that I would be having a very cautious view on that. That the first 2 quarters yet looks little not very buoyant. I would be far more comfortable and confident to say that their CY and my FY25. So their CY25 looks more. I'm more confident on that than the CY24 of the international players. However, it's little early in the day for me to really comment on the full year for them. But I would say that I would be cautious for the first 2 quarters before I really say that the demand has come back strongly. Is there a strength? Maybe there is a bit of a strengthening, but I would wait for 2 quarters, honestly.
Fair enough. Second question is in terms of the LOIs. So out of that 9,000 crores of LOIs, how much of the contribution in FY24? And if I'm not wrong, earlier for FY25 we expected close to about 400 crores. So does that guidance remain? Thank you.
Perfect. So let me divide this LOI piece into two different parts, and then we can talk about it, and I'll answer that fully for you. LOI to get commercialized, we will take at 18 to 24 months kind of a time period. And 2 is typically once you commercialize it, it takes you another 18 to 24 months, or 24 plus or minus 6 months kind of a time period for a full ramp up in that sense, because the volumes take its time to ramp up fully. So if you look at my the LOIs and contracts that I signed in 2022, they have started yielding revenue. This year we should have done little less than 200 from the LOIs and contracts, and next year it's just it should do reasonably well. Will it be? It should be in the range of 350 plus or minus 20-30 crores is what I would look at for those numbers.
Sure. And just one last clarification. So we've been, when I understand you don't want to give a guidance on the top line front as of now, but given that the raw material prices have alleviated, stabilized, so would our margins will be in the range of 26 to 28% as we had guided earlier on standalone basis?
Margins, I think we should be looking at around 26 or 26 plus % kind of a thing, right? So what we have been guiding is 26 plus is something which we should be looking at.
So and any guidance? Yeah. So any guidance on FY25?
I'm just using some humor here. That's all. Nothing.
No worries. Just any guidance on FY25 and working capital days that we want to put up as of now?
Give me 2 quarters. It will cover this for sure. I assure you of that. But give me 2 quarters to answer that. So at least a quarter or 2 to see how it is moving on. Because I'll tell you why I am saying though. So because my revenue mix is changing significantly, and the velocity that I am expecting from the cycle to come back is something that I want to see before I really commit on that.
Fair enough. Thanks a lot and best of luck.
Pleasure, yeah.
Thank you. We have our next question from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Yeah, just a couple of follow-up questions. One is in terms of the number of shares you reported in the filing, does that include the number of shares equivalent to the warrants, or for dilution should we take the entire conversion of warrants, that 39 million?
So number of shares does not include the warrant share, and so you should count for the dilution in that.
Okay. Second thing is, now somebody asked this question on the share of revenue from the LOI. So how do we, look at the impact of the bunching of some of these orders getting executed? Maybe 3 years down the line, say 27 to 30, if you take a 3-year view beyond 26, what would be the kind of run rate in terms of revenue addition from the, order book you have as of date?
So Ramesh, let me put it this way. I would not want to say that. Let me tell you that, let's say we have a 9,000 crores of little less than 9,000 crores of order book, right? So if I just divide it by even 6 as an average, because there are some at 7 years and some at 5 years, 9,000 divided by 6 would be in the range of 13 to 1400 crores of number, and that's the kind of a number that you should see. But also you have to be mindful that there are some which would have started in 2023, 24, and they would be tapering it off at that point in time. But as of now, I would say that should have contributed 13 to 1400 crores of revenue from there.
So, okay, that's a delta from the new orders, right?
From the day it started. So you have to say that some of it has been reflected in this year's number also, and I'm talking about total like that.
Yeah. Plus what you will get the revenue from the current portfolio, which will continue to run, net of whatever is happening.
Exactly. True. Yeah. So current portfolio will expand. There are LOIs which will expand, and then also my pharma and polymers will also have their contribution. So yes, true.
No,
this is not the only delta. This is not the only delta revenue that we will expect.
So, but pharma and polymers will be part of these LOIs, right?
Some of them, not all of them.
Okay, that means you're saying there will be sales outside the LOIs. It's an annual business.
Yes, it would.
Okay.
Yes, it would.
Okay, fair enough. Thanks a lot. Wish you all the best.
Thank you. Thank you, Ramesh.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Madhav from Fidelity. Please go ahead.
Yeah, hi, good evening. I just had one question on the working capital side. So I remember the last couple of years we've been highlighting that we want to change the pricing contracts for many of our customers. I think it used to be a yearly contract for 6 months or lower. Could you help us understand, from the IPO time 3 years back to now, what % of our customers or revenues have shifted to a lower sort of pricing duration? If you could help us with that. And also just curious, if we have 320 days odd inventory in the standalone and 70% is finished goods, so we're carrying 200 days of finished goods inventory on the balance sheet. Just wanted to understand why are we carrying more than 6-7 months of inventory of finished goods on the balance sheet? Just trying to understand the sort of thought process there. Thank you.
Okay. So Madhav, around 60 odd % is coming from the 6 months kind of a contract, 6 months pricing kind of a thing. And when I said 60-70% of it is not only finished good, it is finished good and WIP. I was talking about 30% from the raw material and balance is WIP and finished good. And that's put together it is there. And just to give a little flavor on that, there are products where we have a multiple steps that we do around anything between 8 to 12 steps or more. And there, each of the steps you will have a particular level of inventory which is in the WIP that will be counted. So that is the reason it is there. The exact details I can share I don't have it handy, but I can share it. Which is what
the 60% revenue which is from the 6 months pricing contract. How much was this during the IPO time, 3 years back? What was this number then?
At IPO time, if I remember, the number was 15 to 20%, which we've now gone up to 60%. But mind you, what has happened is that another thing is that because of the kind of volatility that has been there, they have been insisting on holding higher, and that is what I'm saying. I think, but as we go, we want to go back to the numbers that we have agreed with them, which is where we hold lesser inventory and lesser working capital. And all the new contracts that we are signing, we are conscious of keeping it at a 6 months kind of a pricing rather than a 12 months kind of a pricing.
So just wondering that, given that, sorry, go ahead.
Yeah, please go ahead.
My question basically was that, given that the customers have been destocking globally, this is like a phenomena across the agro value chain. Given that customers are destocking, why do we need to keep higher inventory on our balance sheet?
So I think, Madhav, the only thing I can say is three points, and let me put it in this way. One is, earlier we all were keeping it on the whole value chain. Now they have started destocking, but we have been keeping it, and we expect that this destocking for us will also happen in next few months, because see, customers will drive the first leg of the destocking, and second will come from us. So we are insisting, or we are keen on doing it. It's only that two things are happening. A, the slower growth means that lower destocking happening, and two is when your customer is destocking, your leverage to destock will be that much limited. But as we go, that number will have a better line of sight on that, a better ability to do that.
Okay. And so the pharma business, which is expected to go up, what is the working capital cycle there for that part of the revenue?
So there the inventory levels will be lower, but there will be a little bit of a higher receivable cycle, because in India, because that revenue will come from India, and the India working at data cycle is little longer than what you see in the international market. So you will see a little higher bias towards data, but on the inventory side you will have a correction. So net, I think we should be on the positive side rather than on the.
How different is it, sir? Broadly, agro, let's say our target is to be 200 days by FY26. Pharma is like at what level?
So see, pharma, I would put it. Let's say there is a 120 days of receivable. Let's say though they may write 90, but they may end up in doing it. Let's say 120, and I will have our 60 to 70 days, 60 to 90, 60 to 75 days on in terms of payables. So. And then inventory would be, let's say, 90 to 120 days. So I should end up around 150 or little less than 150 is where I would target for now. Initially, when I'm starting my business, little bit of aggression, and then you will try and work on that.
Okay. And margin profile is probably similar for pharma versus agro revenue for us?
So typically margins will be in the range of 25-26% kind of a thing. That's what we are looking at. It will be slightly a percentage point little lower, but today we are on the KSM side. So KSM we have a decent strength there in terms of pharma. Maybe a percentage point you may want to take it a little lower than the agro side.
Okay, got it. Thanks a lot, sir.
The only thing I want to add is polymer may have an interesting play, but I don't want to opine on that for now.
Understood. Thank you. Okay. Thank you.
Thank you. We have our next question from the line of Yash Shah from Investec. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, my first question was regarding the current LOI which we have. The LOI which we have of nearly 9,000 crores. Have we basically witnessed any kind of dialogues with the customer wherein the customer has asked to, wherein there have been pricing renegotiations due to the overall decrease in the prices throughout the value chain?
So yes, see, our model on pricing is very simple. We build it from a raw material to all inputs, and then say I want a particular level of margins. So that's where it is. So it's a very, very, very fluid. It's a very, very transparent pass-through kind of an approach. So for me, the key important number is EBITDA rather than my revenue. In terms of a contract, I'm saying, right? So volume is assured, margins are assured. Now the volume price revenue is the pass-through in that sense to me. So if the raw material prices increase, my revenue may increase a tad bit, and to that extent, the percentage of my revenue will be equal to my EBITDA, and same other way around. But so for me, we don't have that conversation of what is going to be the price. Do we renegotiate the price? Because that's anyways readjusted every 6 months going forward.
Okay, sir. Got it. Sir, my second question was regarding, again, you actually guided that the revenue from LOIs for FY25 should be in the range of somewhere between 320 to 370 crores. So far, as of FY24, we've commercialized contracts worth 2,700 crores. And for FY25, we had guided to basically, except for the 2,200 crore contract from Japanese customers, so we'll be basically commercializing 4,200 worth of contract in FY25. Will you be able to provide a broad breakup as of the contracts which have been commercialized before this year and the ones which are going to commercialize in FY25? Of how are we basically expecting 350 crores?
So I'll tell you, so you can take that the FY22 contracts have been commercialized, and the latest one that we had signed is what we have commercialized. So these two, these are the ones that we have commercialized. And now next year we may commercialize the other few of them which are coming, other three which are the ones that we've signed in FY23, 20, or later half of the 24. Oh, sorry, later half, the early part of the 24.
Okay, sir. That's helpful. Thank you.
Lovely. Thank you.
Thank you. We have our next question from the line of Siddharth Gadekar from Equirus. Please go ahead.
Hi, sir. I just have one basic question. When we look at our contracts, which are annual, given that in CY23, if a customer had indicated they would be picking up X quantity, by year end, how much lower was that offtake from those customers? If you could give a fair sense in any ways.
So if you look at it, typically there is an NGO and there is a forecasted volume. So typically forecasted is, let's say 100, then the NGO will be in the range of roughly around about 70 to 80% of that number is an NGO, and typically that's where we are talking about.
Okay, so basically it would be fair that the offtake was 20% lower than what the customers had indicated in CY23. Would that be a fair understanding?
Yeah, you can say around 20 odd %. Yeah, you can say that.
And so suppose CY24, how has that number shapen up, like in terms of the customers? How have they indicated for CY24? Is it too early to give any indication? So even they have put that on hold?
See, that's what I'm saying. What I had mentioned, and I don't want to get deeper onto this because, there are a lot of moving parts here. But as I said, first 2 quarters look little tepid, and the next 2 quarters will be better. And overall, we expect that there should be growth. So I think that would really, indicate to you the kind of conversations that we have had with our customers.
Okay. And so for CY25 also, have we received any indicative orders from the customers, or that will happen once we are closer to the end of CY24, or CY25 looks a year where we will see a very healthy growth?
That I can tell you that, yes, that's where people have been. So our customers have been saying that CY25 looks far better than CY24, for sure. And the CY24 looks better than CY23, also is a statement I can say. And yes, the buoyancy on 25 is far more than the buoyancy on 24 compared to the previous year.
Okay. So just one last thing on this. So is CY25 volumes higher than CY23, or it will be in that same ballpark range on the existing orders, not on the new orders? Just to get a fair sense of how our customers are thinking.
It should. No, it should. It should be higher. It should be better. We should have caught up. If that is the question.
Okay. So secondly, in terms of margins,
but please see, because I'm recorded and I want to make it clear that these are our estimates and expectations. Please be mindful of that.
Yes. So secondly, like in the previous comment, you had mentioned that we work on a percentage margins. So do we work on a per kg margins or a percentage margins? Because if revenue
percentage.
So in an environment where raw material prices are moving up, our absolute EBITDA is technically much higher than what it should have been. Is that a fair understanding?
You're right, but see, you have to always understand that if you look at my raw material cost is what, 40% of my 35 to 40% of my revenue, right?
Correct.
So that translation is limited, and you will see over a period of a long term, over 5 to 7 years time period, that everything levels out. So yes, quarter to quarter, you may see a bit of a up and down, but on a long-term basis, you will see that everything levels out for that. That's the business that we would want to talk about, and that's the business that we want to build. That over next 5 years, 7 years, 10 years, how does it look like?
Okay, got it. Thank you. That's it.
Thank you. We have our next question from the line of Rohan Gupta from Nuvama. Please go ahead.
Hi, sir. Good evening, and thanks for the opportunity. Sir, a couple of questions. First is on this, if a contract and our fluorination business, if you can give some sense, what is the current capacity utilization? And in FY25, FY26, looking at the current product pipeline, what kind of utilization level you are looking at?
So one, TENFAC, if you see, they had a capacity on the SS side which was 20 to 80% utilized, but they have gone up and expand. They are under the expansion phase right now, and the HF capacity will double by in next year. And hence, if you see, there is enough and more capacity available for us and also for TENFAC to supply to the market. So to that extent, the availability of HF and KF would not be a challenge to my mind.
No, sir. My question was other way around. That in HF, we still have some surplus availability, and are we able to sell in the market? What are the capacity utilization level for HF we have seen at TENFAC? I mean, is there market in HF right now? Because earlier, TENFAC used to sell significant amount of HF to outside. How is the market now? And once we are moving up in the value chain, then what are the expected utilization levels for TENFAC next year?
So I think for TENFAC, if you see the volumes as per the plan has been achieved in terms of capacity. In terms of volume, if you were to talk about. Yes, there has been a little bit of a price movement here, but typically the volume side they have been able to do decent enough there. Do we see that there is a overcapacity? And today doesn't look like, because this year as we have started, the numbers look decent for now. But let's see how the demand pans out later in the year. Right. Because today also the capacity is limited for HS in the country, and the utilization is only increasing of HS.
Sir, second question on our agrochemicals. 60-65% of our business is still coming from agrochemicals. There we have been seeing that very less of poor visibility as of now, which even you are also agreeing that maybe first half may be slightly uncertain and things should pick up in second half. That is the expectation across the industry right now. So with that, keeping in that mind, though, we have been signing multiple LOIs, and a lot of LOIs were supposed to go on stream from, in this year in first half also. Do you see that from the client's interaction right now, which you are seeing, there can be further push-up, further delays? How the contracts are, have been chalked out, that in case of any significant delays, are we covered because the capacities have been invested? So are we covered in terms of client compensation, any of such things? Because our business over next 2 years is a lot of depend on LOI. I'm just worrying and I'm trying to understand the risk associated with that. If any delays, how it will be panned out in terms of the compensation to our profitability.
So Rohan, let me answer it in 2 or 3 parts. First part is that if you look at it, I don't have any dedicated plan for any product or any customer. Okay. Each plant has multiple usage and they are multi-purpose. And if you look at the product portfolio, I have a decently large and a spread out product portfolio. So to that extent, any one product really impacting my utilization or my revenue is limited to that extent. Their impact of that is limited. If you look at this year itself, I've launched 17 new products. Next year, I'm looking at another 6 odd plus products, 6 to 8 odd products. So if you look at it, total portfolio, if you look at it, I'm talking about 70 to 80 products that is there. Now, yes, there may be some plus or minuses on any 1 or 2 products that can happen. That may happen. I'm not saying that it will not happen. But that is also budgeted in and planned out. And 2 is also that the ability to impact my total capacity utilization or my revenue or my numbers is that much more limited. That is all I'm trying to say. And the third part is that are we expecting it to be inordinately delayed? Right now we don't see any. A quarter or two really doesn't swing into the game if you look at from a complete a broader perspective, and that's where I would put it.
So I was trying to understand more from the contractual perspective from the customers. I mean, if there are further delays, customer doesn't give the material maybe for another 6 months, 1 year, are we protected? Is there a take or pay kind of contract? That's what I wanted to understand, how the contracts are placed or written.
The contracts are take or pay. Contracts has a minimum offtake agreement, right? So that anyway kicks in. Now that always kicks in, but how you solve it is you have a multiple ways of solving it, right? I can ask for a compensation. I can ask for a bit of a price adjustment. I can ask for a different product. I can ask for a higher volume to compensate for it in the next quarters. So there are various ways to solve it because these are all long-term customers who are saying I'll honor what I have said, but let's find a win-win solution, and that's what we will always do that. But the question, if you are asking, is that am I getting compensated? Yes, one or the other way I'll get compensated. And contractually, I have a compensation clause that is there, and that I use it to get what I want. In fact, when I give one, I get two many times.
So that's it from my side. Thank you, sir.
Thank you, Rohan.
Thank you. We have our next question from the line of Meet Vora from MK Global. Please go ahead.
Yeah, hi Vishal. Thanks for taking my question. So we mentioned that the peak revenue potential from current gross block will be around 1,600-1,700 crores. Now, including the fluorination block that we are putting in, what would be the total peak revenue potential that we are envisaging?
Yeah, so all put together, I think this should be in the range of plus 3,000 plus. Hello, sorry, I didn't get your question. Can you ask me again? Sorry.
So I was saying that currently we mentioned that the peak revenue potential from current gross block will be somewhere around 1,600-1,700 crores. Now, including the fluorination block that we are putting in the 670 crore capex, what would be the peak revenue potential from the combined gross block?
Okay, so first let me clarify on one thing, and that's the reason I asked you a thing, is that the new capex I'm putting is not only fluorination, it is fluorination plus other products also. So put together 670 crores is 3 plants, of which 2 are more supporting the fluorination and 1 is supporting LOIs and other products. So when you add all put together, the revenue potential that I can generate from that, I'm not guiding for the revenue, but I'm guiding for the capacity that it can generate revenue. We should be looking at around about 3,000 crores of revenue, assumed with the current kind of revenue mix that we are seeing.
And this would include the LOIs, all the LOIs that we have signed.
Yes. So I'm saying that all the products that I have today that I'm thinking about the one will be catered from these plants.
Correct. So say if, at peak we reach somewhere around 3,000 crores, around say 1,300, 1,400 crore would also be from LOIs.
Yes, you're right. Correct.
Sure. And also, in terms of the LOIs that we have signed, do we need to incur any new capex, or largely everything is done with this capex?
No. So with this capex, we are practically done with this plan.
Sure. And also, just one last bit, what would be our our capex guidance for FY25 will be the balance capex that we have guided around 180 crores, and like FY26-20
plus some maintenance capex, please.
Plus some maintenance. Okay. And what would be that number for FY26?
It should be more on the maintenance side. I would put it at that number. Because I have right now no plan on the capex.
Sure. Understood, sir. Thank you, Vishal. That's all from my side.
Thank you. Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Vishal Thakkar for closing comments.
Thank you everyone for your active participation and your questions. We hope we have been able to answer all your queries. If there are any that are missed out, please reach out to EY, our IR partner, who will be able to help you. And we are happy to connect with you offline as well if there is any questions that you have. Thank you very much for joining and taking time out for us. Thank you.
Thank you. On behalf of Anupam Rasayan India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.